Welcome to the daily update, where I'll go over the action in the market for Friday, March 22nd, and then we'll see how things look for Monday, March 25th. It was a pretty sleepy day compared to the excitement that we saw earlier in the week. We ended up closing down slightly for the S&P. I wouldn't even necessarily call this a pullback. I would call it more of a consolidation. And I know that's splitting hairs between words, but a pullback is more of a decline. Yeah, we saw some weakness coming in Friday's session. There was no economic reports that the market could key off of. We had a good run. We're seeing a shift over to a more positive environment. And still longer term, things are looking rather strong. So to see the slight decline was not really a surprise, especially ahead of a weekend. Now, what we'll do every day, like I do in these videos, whether we go up or down, we'll just fall back, regroup, evaluate things. We can only go with what we're seeing right now and then evaluate where we're at and if we're looking more positive or negative. For right now, we're still looking more positive, even with the slight down day. Please know that I did post earlier in the week a video on YouTube and Rumble about the proposed program that I plan to launch right around June or so. And this is just part one. There's other areas that I want to go through and explain to give you as much information as possible to see if this is something that may interest you. That is available for you to watch. So please feel free to check that out if that is something that does interest you. Let's go back and talk about what happened. We did have a lower open and prices chopped down below S1. We kind of just chopped our way below it. S1 was at 52.34. We still kept going down, but we did not get to S2 at 52.27. As the day went on, then we chopped along S1. We were able to climb back to the unchanged level and actually go positive briefly. But then going into the close, prices fell back down to close pretty much at S1. We were down 0.14% on below average volume. We're not seeing an awful lot of volume these days. That has been dropping off, especially in light of all the major things that have been happening lately. We are positive with our technicals on all the different time frames. We're still looking a little overextended, but we've been looking overextended pretty much from after we had that little trouble in early 2024 and then started to come up out of that. The market has been pretty extreme, which we want to be aware of that, but at the same time, that also is suggesting really solid momentum as the market is looking pretty good these days. But we want to be realistic too, realizing that there are times when the market goes down, whether that's going to be a decline of just a pullback or we're going to turn into more of a correction. We don't know that at this point. But for right now, even with the solid down day, we're still looking pretty good. The inflation and interest rate scenario is now shifting and is more in the market friendly camp, at least as far as the Fed is concerned. The CPI and PPI are still causing some concerns, but when the Fed came out and switched to more of a dovish stance, that put the market at ease, and we've been seeing some positive action since then. But we want to see things going forward. Was that an anomaly with inflation? Is it going to come back under control? We also want to keep an eye on the employment situation. And then we also want to just be aware of all the different things going on around the world that sometimes can have an impact on the market. Some comments. The NASDAQ ended up closing at a new all-time high, and small caps, they had a good day on Thursday, so naturally they had to go down on Friday. And regional banks got hit a little bit. There's still that concern that even though interest rates may be getting more friendly, there's still a lot of left behind type situations that these banks are going to have to deal with. There's refinancing. Now, there's some folks that say this could really cause some problems, especially in the commercial real estate industry, because companies are going to have to refinance. They're going to have to pay a lot more after the lockdowns. Some companies are not using as much office space as they were. And then that's the negative side. The positive side is like, well, this is just a good old boys club, and they're just going to change properties back and forth with each other and find a way to work it out, and nobody's really going to get hurt. So where's the truth? Probably somewhere in between. But depending on who you listen to or what you look at and what your interest is, you can create a real doomy and gloomy scenario about what's happening in the commercial real estate, or you can be more positive. So I like to come out with at least starting by shooting the middle and then leaning one side or the other as the situation works itself out. On the short term, we still have our Stoch RSI, Williams percent R, the CCI 14 and 20, and the stochastics. A little bit shorter list, but still, these are our usual suspects. Whenever we have any kind of a move, either up or down, these get on the list pretty quickly. Intermediate term, our oscillators, they're turning a little more positive. In the short and intermediate term, we're trying to come up above the moving averages, but we're already getting pretty extreme positive readings there. I forgot to put this on the list for Friday's video, the boom indicator. We did have the boom 20 period, meaning that we were getting far away from the 20 period moving average. And the boom indicator should have been on this list, and it's still on this list. That's a more intermediate term moving average, so it takes a little longer for that to work out. The CMB composite is still extreme positive, the Sean trend meter, and then our new high, new low study for the S&P. Long term, we're still dealing with these long-term moving averages, the 150 and 200s that are looking extreme positive. I've worded this a little bit different now that we've got to the end of the week and things are becoming a little more clear. The scenario that I'm going with right now is that the Fed is likely done raising rates and looks to cut rates possibly 3 times in 2024. Of course, that's the debate. They come out and they say, okay, we're likely to cut rates 3 times. And then you have people that say, well, no, they're only going to cut 2 times. That was in a graphic that I showed yesterday. And then somebody else is going to come out and say, no, they're going to do 5 times. Okay, that's what happens in the financial markets. But this is what it's looking like for right now. The dollar was up. It actually had a pretty strong day, in spite of the potential of interest rates coming down, because usually the dollar and interest rates tend to go up and down together. Interest rates ended up being down, and this is helping the market a little bit. And that's why I said Friday was more consolidation, because we dropped down to 4.22% for the 10-year yield. So we dropped a bit there, even though stocks in the S&P ended up declining. We're still inverted with our yield curves. And we did drop a little bit. We were extreme positive at 75. Now we came down to 72. So we're still positive. But the context is now that we're declining. So we just want to keep an eye on that. We're still positive with our trend. The ADX, both in the short and intermediate term, they're still trying to climb above the moving averages. So that could suggest a strengthening trending environment with the green line on top. So we are positive. And our bias, you don't usually see this for the bias, because bias is one day, whether we have an up day or a down day. I actually changed that over to mixed, because we saw some different indexes, like the NASDAQ was up. We saw the mega caps doing well. The S&P could have just as easily gone up in Friday's session as gone down. So I'm keeping that at mixed. Where momentum is the last 2, 3, 4, 5 trading days kind of taken together. And this is a subjective thing that I do, where I try to let the rest of the video speak for itself. We're still positive when it comes to momentum. We didn't have any economic reports in Friday's session, so there's no charts. This is put out by Real Investment Advice, and this is where a lot of the strength has been coming from the last 10 years, is companies going in and buying their own stock. Well, when you've got a big company buying their stock, that's going to push prices up, and that also makes their stock more attractive because there's less of it available, so it makes it more precious, and that feeds into the idea of supply and demand. If there's less supply, there'll be more demand. And I just quote along the top, buybacks alone have contributed up to 40% of the bull market rally since 2012. Actually longer than that, I said 10 years. It was about 12 years. Underscoring the substantial influence on the overall performance of the U.S. stock market over this period. And this is just showing in a graphical way the cumulative change in share buybacks. And this is, you could call it manipulation. You could call it whatever you like. This also helps their accounting and their earnings reports to look better as well when they're going in and actually buying their own stock. So this typically happens in more positive environments. And since 2012, yeah, we had the whole COVID plunge here, but we quickly bounced up out of that. And we had 2022, which was a very difficult year. But overall, when you look at this long-term chart, the market has about a 70% chance of going up. That's a real loose definition where we tend to be positive 70% or negative about 30%. And you can fiddle with those percentages. Here's another look at the annual buybacks. This is put out by Goldman Sachs, and then their projections of what is going forward. And they see in 2024 and into 2025 where more companies are going to be buying back their shares, and this could give solid support to the stock market. And here's the returns. S&P 500 gains between 8 and 10% are quite rare. If you teach a class like I do and you say, okay, over the last 120 years, the average return for the S&P has been about 10%, that's an average. So, but getting about 8 to 10% every year, that number by itself is very rare. And you can see going back to 1950, where we either go way above that or we end up going down below it. And there's very few times when we actually hit that 10% level. This is just an average over a period of time. And then this chart, unfortunately, it has some Elliott wave on here. I am not an Elliott wave fan, not because there's weaknesses in Elliott wave theory. It's a good theory, but it's very subjective. You have to come up with your own conclusions. And the folks that do this tend to be the perma bears, and they're always, drawing an arrow down from here. But I just wanted to show you, this is a chart of gold. And according to this chart, we still have more upside potential when it comes to gold. And these are cyclicals versus defensives. Cyclicals, they cycle with the economy. So when the economy is doing better, we're in a more friendly interest rate environment. The cyclical stocks tend to do better. When we're in a more defensive, rising interest rate, slower economic environment, that's when the defensive do well. And we're coming down a little bit, but overall the cyclicals have been doing better according to this chart. And then looking at value versus growth, these valuations, we're getting down here into this low area. Now the talk is starting to be, what's going to happen with the small caps? How come they haven't really kicked into gear? Now, I don't do the small caps as part of my program, but we keep an eye on them because in a more positive environment, it tends to do better for the small caps, especially when interest rates are coming down. And this is just showing on a ratio basis. You have the Russell 1000, which is value, comparing it with growth, and it's coming down, but could be bouncing off of what they have here is a -2 standard deviation level. And I've shown these charts now for a couple of years, showing that the small cap growth is undervalued. But then you have to look inside and say, okay, it might be undervalued, but is there any value in there anyway? Then I did have one interesting chart. I'm constantly lambasting the perma bears, and rightly so. I don't see myself as a perma bull. I don't see myself as a perma bear. But this time I ran across this headline. This guy tends to be a perma bull. And Fun Strats Tom Lee, I thought he was a drummer for Motley Crue or something. He sees small cap, the Russell 2000 index, surging by 50% in 2024. And we don't know. Is he going to be right? Is he going to be wrong? I mean, this is like a crystal ball look. This is like predicting the weather 6 months from now on a particular day and a particular time. But okay, I just thought to try to be somewhat fair and not only pick on the perma bears, I'd go after the perma bulls from time to time. Here's our intraday chart. Really sleepy day, and both Thursday and Friday, we saw all of the advance pretty much in the gap on Thursday, and then we drifted. And then because the intraday range was so small, that made the pivot points really small for Friday's session. We didn't have a gap, but we ended up drifting down below S1. Then we trailed along S1. We tried to go positive for a while, then drifted down, and then ended up closing pretty much at S1 for the day's session. Here's our intraday chart. Not anything all that exciting. We were flat in the initial overnight session, saw a little bit more strength and then some weakness pre-market. Here's the cash session, and then we're not really showing much as things close for the weekend. This is an improvement. We're seeing the blue line above the red line here, so growth did outperform value on Friday. That's encouraging. And we're still range bound here when we look at S&P growth of value, but we were up overall, and that's showing some internal strength as well. End of day, growth was up where value was down with the large caps. It was down less for the mid caps and also down less for the small caps. And then the middle area are the corresponding ETFs. When we look at small cap growth of value, we did turn back up a little bit with our ratio on our end of day charts. We're coming down into the lower end of this range. Mid caps, this is where we've seen more of the strength a lot, especially into 2024. This index has been doing a lot better. It's coming off setting recent all-time highs. The growth to value ratio has been stronger, even though we have been pulling back. It ticked up a little bit in Friday's session. We also ticked up with the S&P growth to value ratio. So we're still hanging in there. We're chopping sideways, but we're still maintaining a positive trend. When we look at discretionary to equal weight, we did tick down here. And this has been an area where we're still on a longer term uptrend. It's not performing as well as it did earlier on. The big three sectors were tech, communication, and discretionary. Discretionary is kind of fallen away right now, where tech and communication have still hung on pretty solidly. Large cap growth saw a little bit more of an uptick here, so we're back to setting new all-time highs. The mega caps had a good day. Looking at our trend, we are trying to go above the moving average here. They're still pretty much right on top of each other. So this looks like the trend could be getting a little stronger. However, the green line is still above 40. So that's something that we just want to be aware of. We're also above 40 with our short-term chart, and we're also going back up above the moving average. So the trend is positive, but be aware we are above 40 with the green lines. We have been dropping off when it comes to volume. Sentiment, this hasn't been updated now for a few days. I just keep this in here so it reminds me to update it when the new chart comes out. We're still, the latest reading was that we're above 4, and that's a pretty extreme reading. We turned back up just a little bit with the VIX on the line chart as well as the bar chart, but the VIX overall has really been declining as stocks have been going up, and we broke this pattern of setting higher lows that pretty much started at the beginning of December. And we came down a little bit with the volatility of the VIX, and we're getting very low readings here. So that's a little bit of a concern. We're still getting an extreme reading with the skew index. Not really anything happened in Friday's session to change that. This suggests that the market is anticipating some kind of a big move. Is it going to be up? Is it going to be down? We don't know, but the option positioning is suggesting that some kind of a move could happen. The VIX is continuing to trend lower when we look at the momentum as it's been dropping off lately. And with our equity put call ratio, we came down, even though we had a slight down day. This might have been a lot of post-Fed meeting hedging coming off. And so we saw more calls than puts. And when we see that, that's when the ratio declines. But we're still going up with our 5 period. So this tends to lean more to the negative side for right now. The risk premium, it did tick up, but we're still in this sideways range. And I wanted to show this additional chart from Real Investment Advice. The guy's name is Lance Roberts. He does like an hour-long pre-market video that some of you might find interesting. Sometimes I watch him, but most of the time I don't. Anyway. It says the risk premium for the S&P is now below the average investment grade bond spread. That's just showing that there's just not an awful lot of risk in the market right now. The purple line is just measuring S&P risk premium, and that's really been dropping, meaning there's not much fear. And now it's even below the investment grade index, which has also been declining. But when we look at our advanced decline line studies, yeah, we were down slightly based on price and volume, but this is still holding up. We're flat at the top with our 5 period moving average of the new highs and new lows. We rolled over just a little bit with our 10 period, and we really dropped off when we look at the raw score for the new highs. We're still looking positive with the advanced decline ratio. So that's hanging in there for right now. We did come down and we're coming back to the moving average with the accumulation distribution. That's a bit of a warning sign. And the Chaikin money flow also is a bit of a warning sign. It's been really trailing off, even though it's still positive. We're coming back down close to the midpoint with the Chaikin oscillator. We did decline with our advanced decline line studies with the NYSE common stock, but still coming off of a really high reading. We declined in a high reading with the S&P, declined with the mid caps as well as the small caps. And these other indexes are looking stronger. The small caps are still not really breaking out, and they are lagging behind. Here's our daily chart where we ended up finishing out the week above this pivot point. So that's positive for right now. Now we want to keep our eye on this other pivot point above where we're at. If we see more weakness, we'll be looking at this pivot point, which carries over into April as well. They're pretty much at the same point. So this area could end up providing some support. On the bottom, we dropped to below average again with volume. We're still extreme positive with the Stochk RSI, the Williams percent R, the CCI 14, and the CCI 20. We're no longer extreme with the boom indicator measuring the 20-period moving average, but we're still extreme with the 50. Takes a little longer for that to move. We want to keep an eye on the 20-period moving averages. We're still well above them for right now, but if we see some real downward action, we want to watch this for potential support. We're no longer extreme with our 20, 50, and 200-period moving average studies. We're still positive, even though we declined with the force index. We're still extreme positive with the stochastics in the short, intermediate, and long term. Please be reminded that this is a further subdivision of the short-term time frame. We're no longer extreme with the standard deviations chart. We're just on the border between +2 and +3. So with the slight down day, we're not getting a real extreme reading. This is a little more negative now. The balance of power is actually dropping below zero. It's picking up some negativity. The CMB composite is still extreme positive above this black line. We're still positive with the go, no-go system with the darker blue bars. We're still looking positive with the highest high value. The TTM squeeze is still positive with the lighter blue bars. We declined a little bit, but we're still positive with the ease of movement. We were flat with the Arun indicator after giving us a recent extreme positive reading. We declined, but we're still above zero with the S&P McClellan oscillator. So we're still going up with the summation index based on price and volume. And we declined with the NYSE McClellan oscillator, but we're still above zero. So we're continuing to go up based on price and volume for the summation index. And if you compare these two, the volume chart is still looking a little bit stronger. It's more parabolic than what we're seeing with price right now. That's rather encouraging as well. And another reason why we're still maintaining more of a positive stance, even with the down day. The Swenlin trading oscillator is looking more positive based on price and volume and did advance. We're trying to turn up with the PMO, and actually Decision Point had a change in their scorecard that I'll show you later. We're crossing above the moving average, so this is turning back more positive. When we break it down, we're also looking more positive based on price and volume. We declined with the PMOs that are rising. We were flat with the buy signals, and we're getting extreme positive with the PMOs that are above zero. Even with the decline, we're still positive with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. We're turning back up with the slope oscillator, but we're going above this green line, which often is the extreme positive territory. But again, that could also suggest good momentum. The MACD is looking a little more positive, moving a little faster. It's crossing back above its moving average. So we're looking better in the short and intermediate term with our oscillators. We're still pretty much negative in the long term. We haven't really started to turn up above the moving averages, at least yet. We're still above all the plotted moving averages that we follow. We did advance with the bullish percent index. That's encouraging to have a down day for the S&P and to see this go up. That's another reason we're seeing a little bit more positivity under the surface. We did advance with the NYSE bullish percent index. We declined a little bit, but we came back above 50 with the NASDAQ 100 bullish percent index. The money flow did decline, but is still above 50. We declined slightly with the ultimate oscillator, but still above 50. We declined with the vortex, and this is showing gradual weakness over a period of time. If we have an up day, we want to really see this green line turn up. We're still positive for right now, but we're we're seeing this really trailing off as the market has slowed down lately. We're looking positive with the RSI based on 14 and 9 periods, and we're no longer extreme with our shorter term RSI. We ticked down a little bit with unbalanced volume, but we're still above an advancing moving average. We declined with the stocks above their 20-day moving averages. This is inside of the S&P after getting an extreme reading, but that just shows a little bit of consolidation or profit taking. We'll want to keep an eye on this. We still have this longer term negative divergence that may cause us some concern. We just want to be aware of that. If we can turn and go back up and actually get back to these previous highs, that would show better momentum. And the 50 period also declined a little bit, also a longer term negative divergence, but still has been really improving lately. We're still looking solid with our 100 period moving average steady, and also looking pretty good with our 200 period moving average steady. And we've negated this longer term negative divergence since we're coming in with a higher reading. The copy curve is trying to go back above its moving average, so it's turning slightly positive, but isn't quite there yet. The Sean trend meter is giving us a very extreme positive reading. On a trend basis, we're still looking good with the Heiken Ashi. We're still pointed up with the Kegi chart. That's positive. The Renko chart is positive, and the 3-line break is still positive. Looking at our trends, we're right in between the red and the blue trend line now. So we're above this other trend line that I drew in here, but we're still below this sharper trend line that we had been riding earlier. And this just shows that the market has been slowing down. And maybe we are now in a new 50 period cycle. So we'll see. Is this going to mean anything? We're topping out at very high values. We do have some possible weak seasonality. There may be some profit taking. Something weird could happen. So we'll have to just see. Is this going to change into more of a decline? Since coming into the end of this cycle, we were going up. Not saying that's what's going to happen, but we just want to watch for that. And we're still looking good here. This is the third week now that we have bars above this R1 level, where before we came right up to this pivot level and bounced below, right up to this level, bounced and went the other way. We're maintaining price above this level and have been for a while now. This is also suggesting longer term strength in the market. We're still extreme with our 150 and 200 period moving averages. And we're still solid positive across the board with the Keller market model, with all the different indexes and time frames. Here's where we saw a change in the short-term PMO signal put out by Decision Point. We're still positive with their trend models, and now they just have their longer-term PMO signal that remains negative, where everything else is now looking back positive. The dates that you see on here, that's when those alerts were actually triggered, or when the signal actually happened. And we just had one measly little alert that was triggered. We had the industrials, which have been showing some strength. They're one of the more growth areas. They're not as interesting or as fascinating to talk about as Bitcoin or Nvidia, but this is showing some strength lately. And with the bullish percent index, this sector crossed above 80. Well, the equal weight is still hanging in there when compared to the S&P 500 index. We did go up with our ratio here. The mega caps outperformed the equal weight index. We came down and just closed a little bit below this pivot level for the Dow, and we switched back over to neutral. The Dow was under a little bit of pressure based on some earnings reports that had been released, and so that's why we switched over to neutral for the Elders Impulse system. When we look at the NASDAQ, and I know there's a mess of numbers and all stuff, the fact that we're just a little bit above this pivot point and closed on a Friday at the end of a week, this is looking more positive. So for right now, we're just a little bit above this pivot point. This had been providing overhead resistance. We're now able to stay above that. And we're just a little bit above this pivot point here with the NASDAQ 100. So this is looking solid as well. We continue to be positive with the QQQs, with the Elders Impulse system. We're trying to cross above the moving average when it comes to momentum. This has been negative and showing a negative divergence. If this could cross above and start to really go up, that would be more positive. The Qs are still above all the plotted moving averages that we see here. So that's hanging in there for now. The small caps ended up being down. Of course, they had an up day on Thursday, so they had to go down on Friday. And you might think that I'm involved in the small caps or I do the ETF. I don't. It's just This has been a real disappointment for folks, and that gets frustrating to see sometimes. But we're still positive with the Elders Impulse system when looking at the small caps. We did decline with the Russell 2000 small caps. We declined, but we're above 50 with the RSI. We're still looking at a longer term uptrend, and we're just a little bit below the moving average when we measure the momentum. The mid caps came up to this pivot point and then saw a little bit of profit taking. This has been a stronger area of the market, and they're still positive with the Elders Impulse system with the mid caps. Here's Google, which was up over 2%, showing some real improvement now after coming down to its 200-day moving average. So that helped the market on Friday. Apple, they're in some kind of a suit. Somebody's going to sue them for billions of dollars and everything. And that took a bit of a toll on Apple on Thursday. Well, they bounced up 0.5% on Friday, but they're still in a downtrend looking at their intermediate term trend. Tesla was down over 1%, also looking a little bit weaker. Nvidia did look to break out just a little bit. We've been in this sideways conglomeration of prices. We haven't exceeded the intraday highs. This is when they came out with their massive earnings report. We'll see if we can get back and actually go above this intraday level. That would help Nvidia quite a bit. The FANG index did set barely just a new all-time high here because the mega caps had a good day. The financial sector was down over 1%, but is still in an uptrend. The dollar really bounced back. It's back up into the 104 area, and we could see a golden cross here very soon. Looking internationally, the red line is the S&P, where it's been doing well. The black line is the MSCI. See, I used to be an MCSE. That's the classes that I taught, so that's why I get this acronym all screwed up. MSCI. Looking at the U.S. compared to the rest of the world, saw a little bit of a bounce in the short-term relationship, but longer term, the relationship or correlation is getting a bit stronger. We did decline with the 10-year yield, and we're coming down here to the 200-day moving average, where we advanced based on price, and we were able to get slightly above the 50-period moving average. We did see a little bit of an improvement here with the QQQs to S&P when we look at our growth to value ratios, but we're still under a declining moving average. We declined with discretionary to the S&P, and we're right on top of the moving average with large cap growth versus large cap value. So the large caps, not much of an improvement, a little bit of an improvement with the mid caps, and a little bit of a turn up with the small caps. We're still looking positive here. This is a broad market measure of the 5-period moving average of the highs minus the lows, and that's above zero, and it did bounce up. It had been coming down, and now it's starting to go back up. So that's positive. We're still looking positive here with our 10-day average of the S&P 500 highs minus the lows. And other than this we've been camped out here in 2024, showing good, solid momentum. So what's our outlook for Monday? On Friday of the upcoming week, the markets will be closed in observance of Good Friday. The technicals are positive, but right now I'm just saying consolidating. And that's not a word that I use all that much because when we're really going down, they don't say market crash. They say we're consolidating at lower levels. And so I try to avoid that word, but it wasn't really a pullback. We're just kind of moving sideways, and that could be more positive for the market. We saw that at the end of 2022, going into 2023, when the market should have been tanking and all logic was suggesting that we could tank, and we ended up just going sideways and then shooting up out of that. So if the market could wear off some of these extreme conditions by chopping sideways, that would be positive. But we still want to respect the idea that we could have more selling that could lead to a decline. We're still above the overhead resistance, and we potentially have some weak seasonality that may make an appearance at some point. And we're not going to have, we will have an economic report. I didn't change this, so I'm going to have to change it. I'll look at the next slide here. But we want to keep an eye on all the crazy things that are happening around the globe because that could have an impact at some point. And it may not impact the stock market. It may impact oil or gold or the dollar or something like that, which could then feed over into what's happening in stocks. So we will get new home sales on Monday. The big one on Tuesday is going to be durable goods. We're going to get some real estate information. also in Tuesday's session. Wednesday is going to be a pretty lonely day, and we're going to get the third estimate now for GDP, which if it comes in about the same as what we saw before, will pretty much be a non-event. It's just if we get a drastic change. And then consumer sentiment, that usually comes out on Friday, but because the market's closed on Friday, we'll be getting that on Thursday. And here's another look at the week coming up where I have the blocked area from Monday's session. Seasonality, where we're neutral to negative with the Dow and S&P on March 25th. We're just flat out negative with the NASDAQ. And we'll be on the 17th trading day of the month, where we see a little bit of a tick up here with the green dashed line. This is during an election year for the S&P. We're wondering if this seasonality is at some point. Now, we're also going to be coming into the end of the quarter. So there's going to be some window dressing going on. There's going to be some portfolio adjusting going on. Whether that's going to have a positive or negative impact on prices is yet to be determined, but that's just something to be aware of. I finally got an updated version of this chart. The green line, this is what we're doing. And look at how we're just skyrocketing up here, where right now, according to what historically has happened, the black line, we should be going down, but we're going in the opposite direction for the time being anyway. Monday is the most positive day of the week. You get people that make their decisions over the weekend. They read up on what happened this past week. They may jump on their computers and enter a bunch of buy orders. That's the open. Then we'll have to see what happens after the open, whether the market just chops sideways, sees an uptrend, or we start to see more of a decline. And then Tom Bowley, we're coming into the latter part of March now, where now his research is suggesting we see more positive seasonality going into the end of March. But we never did really hit the middle part here where we saw the weakness. The warning signs, the equity put call ratio for right now is still going up. The copy curve is negative, but it's trying to cross above its moving average. Another day or two, it could turn positive. Our negative divergences, we're still seeing this when it's coming to the oscillators, and mainly we're going back to the December readings and noticing that the current readings are lower, even though they're still quite high in and of themselves. The small caps continue to underperform, discretionary to the S&P. The transports were actually up in Friday's session, but they've got a long ways to go to look better, and then we potentially could see some weak seasonality. The parabolic SAR and the vortex, they are both positive. We might be seeing some improvement with the vortex, but we need to see more follow through. The NASDAQ 100 bullish percent index, even though it declined, actually it was up. It's above 50, so that is turning more positive, and we're turning back positive with the momentum for the NASDAQ 100. Small and mid cap growth continue to be positive as well. Large cap growth is still holding up very strong. And the financial sector, even though it declined on Friday, is still positive. So our conclusion, we're positive, but right now we're just consolidating. That's kind of a catch-all word for we're not really going down that much, but we're not going up. We're still above that longer-term overhead resistance. We could see some weak seasonality. In the short term, we're still above that shorter term pivot point. We closed above that. That's positive for the S&P. We're still above this overhead resistance on the weekly chart. That's also quite positive. And we also might see some weak seasonality. In the intermediate term, our list of overbought or extreme positive indicators is a little bit longer. And then we're looking solid and very positive in the long term, but we have that 150 and 200 period moving average study that's been extreme positive now for a long time. Thank you. I hope you have a really good weekend. I will be posting the weekly videos. So have a great weekend, and I will talk to you in the next video.